podcast, everybody. Thanks for joining me. Well, we got a market moving today again, and wasn't really moving prior to Fed Chairwoman Yellen giving her remarks, and right off the bat, she came out and basically said, "Hey, we're going to be more gradual with this." Remember, the Fed had planned, when they raised rates back in December for the first time in 9 years, they planned on having 4 rate hikes in 2016. And the last Fed meeting, they said, well, maybe it'll be 2. And now that may still be the case, but she acknowledged that things have deteriorated a little bit since the last Fed meeting, and that they're going to be gradual with these Fed hikes. In addition, she mentioned those 2 little letters that seem to get everybody all hot and bothered, QE. She said, we still have that at our disposal. Now, what's interesting is she admitted that the Fed can only do so much. They can drop rates. They can do QE in terms of fixing the economy. I think that was her saying, hey, we need some fiscal stimulus here and some fiscal responsibility. The Fed can't do all of this. Sadly, the stock market went up today after she made those comments. I mean, you'll see right here, this is when she made those comments. So market was actually negative, and then immediately went positive and kind of rallied throughout the day after she had her comments. So, sadly, it is going up when there's mention of more stimulus. And while, all that does is push money to risk assets, it doesn't do anything for the economy, and that's unfortunate. But we need to acknowledge that the stock market and investors continue to celebrate that. Now, if you look back here, of course, this has been the big thing everybody's been looking at, that we've had this rounding over effect. Now, remember, what we're looking at is this was October of 14. So this was the first time that QE ended, okay? And the market immediately had a 10% sell-off and then went up, eventually got over that. And then we come into last summer, and we had this flash crash. You remember about that, where the Dow was flash crash 2.0, and had that nasty sell-off. And then we recovered. And then, of course, we come into January this year, and we've had another nasty sell-off. So, what do these things have in common? I would say, if you look at this objectively, this right here is when they ended QE, okay? Since that time, really, stocks are up slightly, but for the most part haven't gone anywhere. Very volatile, but haven't gone anywhere. So we had a Fed ending the QE here, and then we have a Fed rate hike for the first time here, and market's struggling with that. Whether it gets through it or not, I don't know, but I think what the bears are looking at is, A, we've got an old bull market, B, you got this rounding over effect, right? And nothing's really changed. So technically, I think what would get people's attention is if we did see this thing break on through, and so it breaks this rolling over effect. Now, there was a period, I don't have it in front of me, but there was a period in 1949 through 57 where we saw a very similar situation in terms of a market that had been running up and rolled over, and everybody thought it was going to roll over and just keep going down, and instead what happened was it turned up and it went up to new highs substantially, and interest rates at that time were even lower than they are now. So we've been through something similar. What we haven't been through is in the past is negative interest rates and some of the things we're going through today. We have 30% of the governments around the world have negative interest rates now, and to us that's a problem. So again, if the profit growth of the companies doesn't start to go back up, then I think we're going to continue to mash around here. Now, the Fed may still keep pat on interest rates, but we may just stay in this as long as things don't deteriorate too much. But what we need it to get going to new highs would be, we need to see oil going back further higher would be helpful. And then number 2, we need to see that profits would start to pick back up again, and they haven't. They've actually dropped. And so a lot of people believe that's going to precede a recession. I don't think we're going to have a recession, but having said that, that doesn't mean that even if we don't, the stock market's great. So again, focus on income. I would also say, I gave somebody some advice today of just saying, don't over trade here. Just think in the last few months, just in 2016, if you came in and you said, I can't take anymore, I'm getting out, you see this big run and it goes back down, you say, oh, I'm glad I got out. And we've had this straight up run since then, and you've been completely whipsawed. So we've made some moves this year for sure, but we have the best thing we've done is not over trade. So that way, again, on down days, yeah, we're glad we have a little cash. We actually have a couple of strategies. We have a small piece of short S&P, and it's offsetting some of the things. We actually think the S&P is the most overvalued part of the market compared to international commodities, things of that nature. And we did see a rotation, I would say, right in probably right in February, this run right here, a lot of that run, you didn't see the FANG stocks, the Facebook, Apples, Netflix, and Google's participating. And everybody said, well, maybe this is the rotation. And it hasn't, but today, that wasn't the case. You're seeing the old stuff lead. You're seeing the expensive utilities lead. You're seeing a lot of that lead. I would say what's encouraging maybe is that we are seeing small caps. This is the IWM. Small caps are up 2.8% today. Huge day out of the small caps. We haven't seen a big day like that in a long time. That was a really large move. So I would like to see small caps participate, and they are. I also like to see junk bonds participate. Not much today, only 0.32%, but we have seen a big move from the February lows till now, up about 8%, which is better than last October when they went up about, about 4%. So we're seeing high-yield bonds participate, and we're seeing small caps participate. We're seeing emerging markets, which I love emerging markets. We've had a move of emerging markets of somewhere around 23% from the bottom. So I would like to see them continue to outperform the S&P 500. So we've seen all that, and you've also seen gold, which had this huge move coming in the new year and then has pulled back a little bit, had a big day up almost 2%. Does that break down eventually, or does it keep running? Well, I would say if the conditions stay the same, it could keep running. But if we get another nasty sell-off, of course, gold could do well. But I do think an easier place to buy gold would be somewhere down in here after this big move. And so this rolling over, we started to see kind of got a reprieve today. But really today was more about, again, kind of the old, what the last few years has been about, which is anytime we see any little disruption in the economy, the Fed's going to jump in there and say, well, we can always do this, and we can do this, and we can do this, and the markets celebrate that. And that's not healthy long term, but it is what it is. We also know that if you look at the S&P spiders here, you see the volume, which is another problem. I told somebody today, I said, hey, isn't it just pathetic? It's getting worse and worse and worse. And I said, what if could volume go negative like interest rates? We could see that. No, but volume is a problem because all you're seeing is a lot of institutions. I think you're seeing a lot of retail people sitting out this market right now because they're waiting for the election or whatever it might be, and the market continues to move higher. So I would caution you if you're ultra bearish and you're sitting in all cash or you're short the market, be very careful. This thing could keep going higher because it's not a very liked market right now. Now, when I say that, the VIX, the volatility index, was down 9% today. So it is becoming a complacent market once again. Remember, we had fear spike up last August. We had fear spike up earlier this year. The VIX had a 30 handle on it. It's down to 13. And so we're on the lower end of this right now. So, yes, you can't say there's fear, right? I would say there's disenchantment with the market from the people who aren't participating. And then overall, there's just a complacency that's coming in. So, again, if certain things don't happen here and we don't see a lot of broad-based demand pick up this market, then we could go right back down to the old lows. So be careful about that. Let's see here, just commodities in general. I would say they look interesting. We're still in our aggressive strategy. We are still long natural gas. I really like this trade. We got in somewhere when it was turning here, ran up, pulled back a little bit. That would have been a good place to maybe take some profits if we were doing a more quicker trade, because you can see that was the old floor became the ceiling. But I think we were up 6-7% on it, but we didn't take that because we kind of feel like this thing has longer to run. I mean, remember, if I just take this and go back to here, you're talking 25%. I mean, let me put this into the context for you. This move right here is 25%. So, if you got back to where it was in 15, this thing could double. UNG could double. So I think we have a lot more upside. And I also like, by the way, look at the volume we've seen. Now there are some funky things with this particular ETF, but look at the volume down here. How much volume? So I like that. We also a few weeks ago bought into the agricultural commodities, and they've had a nice little run, and we think they could have further to go as well. And you can see they kind of broke out here. Almost looks like gold. It was just later. Gold did it in January. This did it in March. So I like the ETF. And this is the commodity basket. This isn't stocks. This is the actual basket of agricultural commodities. But I like the volume as well. So we think this could have a way to go. And this is a little less volatile. UNG is very volatile. Natural gas, and it was up 2.5% today. But it was, I think, earlier today or yesterday, it was down a couple percent in the morning and then turned around. So it's very volatile. DBA isn't that volatile. But we kind of like that commodity space. And, of course, a lot of that's predicated on the dollar, and you still see the dollar continuing to fall here. And, of course, everybody thought it was going to keep running because the U.S. is the best place to be, relatively speaking, I guess, around the world, and that's why you've seen the move. But that was then. This is now. So the dollar is actually moving kind of counter-turn to what people are believing, and that's why you're seeing international do well. You're seeing gold do well. You're seeing other commodities do well. You're seeing that whole trade is doing well, and so that can continue for a while. And then again, I would also watch the Russell 2000 as a relative to see what's going on there. What's interesting today, you can see USO. We didn't get the participation, got about 2% down on oil today. Going to get some inventory numbers tomorrow morning, but I thought that was interesting to see oil did not move with the stock market, which remember it had been tick for the longest time. So I would like to see oil turn around and continue moving higher. I think there's lots of good things that come from that. We still like the master limited partnerships. We own AMLP in our income strategy. And you can see the downturn really hasn't changed, but we got some really nastiness here, which is kind of bullish, I think, where you kind of had this capitulation. You see the volume compared to this, December, January got really bad, and we've had some kind of blowouts, and then we've had a nice little run of that. In fact, since the low on February 11th, those are up 35%. Plus they're giving you over double-digit income. So if you can put up with the volatility, I think it's the cayenne pepper of your income portfolio. So we have some very conservative things in our income portfolio, and we also have this as a balance and getting that income up. Also, it's really interesting that the treasuries look interesting to us. We actually added some of these a few days ago in our one of our income strategies as well. I like the fact that it had broken out. This is almost what I think gold could do. It broke out, and then we came back down and touched this 50-day moving average here, and now it's bouncing off it nicely. So if the market does pull back, by the way, notice how they were up today even in a up stock market. But if the stock market pulls back, you could see TLT go back to these old highs. And again, I'm not looking to make 25% on this. This is just something to add a nice trade in there for our income portfolio. Anyways, so that's another thing. So just those are a few things we've been doing in different strategies. Our aggressive, we still own a lot of companies that are beaten up that we think could more than double, and having to be patient with some of those. They're very volatile. And the other thing that we're doing is we're still short utilities, which has been probably the hardest thing that we've been doing, but we think this is extremely not only overdone in the short term here, but overvalued as well. And of course, when rates go down like they did today, utility stocks are going to go up, and that trade's been there. But some of those valuations are ridiculous. And by the way, this Dow Jones Utility Average finished the day at the index at 666. If you notice here, so maybe that's remember when the S&P 500 peaked at 666, or excuse me, bottomed at 666 back in March of 2009? Well, maybe the utilities will peak at 666 here. So we don't have a big short position on this, but we do believe that utilities are overvalued, and they should be coming down. but that trade has been there for a while. It's all about the Fed. And obviously the Fed's still in play, and so utilities continue to go up. But we think even in the short term, they're stretched. So that's one piece of something that's not working for us. But we're okay with that because we got enough other stuff that is working. But there will be a point that we may have to capitulate and get out of that thing because it's just like the FANG stocks. If you bought the Amazons, for example, or the Googles or Netflix or any of those, those things were having trouble with the screen here, but those things were really moving up very fast, and they continue to go up, and so people are overpaying for certain things, and they're happy to do so, and as long as they keep doing that, so be it. There's just certain things we're not willing to do, and that's one of them, is to overpay for a lot of those types of things, especially utilities which are regulated, and their valuations have have doubled and extremely stretched. So, all right, guys, sorry about that. Can't see that picture of Netflix there, but have a wonderful evening, and don't forget to check out the website, eggerscapital.com. Take care.